My name is Jake, welcome to the channel. In today's video, I'm going to share how I backtest my portfolio, why it's important, and how you can do the same. When I look into 2022, I know a lot of you are probably thinking about New Year's resolutions, things that you want to do or start doing or stop doing. I think there's a lot of you out there that, when you look at 2021, you've probably seen ups and downs in the market. You probably have changed your strategy a few times, and you probably, you thought something was going to happen, but then, something else happened. Then you discover crypto, you discovered, NFTs, you discovered the next cool thing, the next fad. I'm sure there's a lot of cool, flashy things out there, but I think, something that I stress so often here on my channel is, investing should be boring. I mean, your real wealth, it should be boring. You shouldn't really look to see massive upswings and downswings over the lifetime of your portfolio. When you're investing into real assets like real estate or REITs or blue chip cash flowing businesses like Coca-Cola, you want to see that stability. That's why people love investing into the dividend aristocrats and dividend kings, because of that stability. And that your investment is growing, that there is an economic moat behind the company that you're investing in, and it doesn't have to be like the next flashy cool thing. So as you're looking into the next year in 2022, and you're looking at things that you want to maybe start doing or stop doing in terms of New Year's resolutions, I think the best advice that I've ever been given has looked a little like this.
What is the most inspiring thing I ever said to you?
Don't be an idiot. Changed my life.
Whenever I'm about to do something, I think, would an idiot do that? And if they would, I do not do that thing.
Oh my gosh. Oh man. All right, cool. So backtesting your portfolio, what I mean by that is you're looking at the historical performance, and you're comparing the historical performance of your portfolio versus maybe another asset class, another investment, etc. And so I'll get to what that will look like and how I'm going to view that in just a second. But when you're using M1 Finance or any other brokerage, you're able to see, historical performance. And I know that it's really important to throw out the disclaimer, right? We know that historical performance are never a guarantee of future performance. I really like looking at historical performance because it kind of can give you an idea of where you can kind of expect the returns to be, right? If you're looking at historical performance of bonds versus gold versus the S&P 500, I think the further you go back, the more accurate the standard, the lower the standard deviation will be. So I really like looking backwards. I don't like saying, okay, I'm going to look back 2 years and then I'm going to base my theory off of that, but rather I like having a lot more data points to lean back on when looking back at historical data. So here my M1 Finance portfolio. I have my cash flow portfolio, but I also have other portfolios in M1 Finance. So I have the cash flow, I have real estate, and I have our baby Lucas's portfolio that I invest in once a week. But what I want to focus on here is I want to dive into my real estate portfolio. The real estate portfolio is just focused on REITs, real estate investment trusts. In this portfolio, I just really have it on autopilot. Every single day, I'm investing a little bit of money. Every week, there's coming in money from my bank account into this portfolio, and I'm dollar cost averaging. And I have my target weighting versus the actual weighting. And based on the portfolio and the performance of the portfolio over the long term, I'm really taking advantage of the dynamic rebalancing of M1 Finance. And what that means is when one of my investments are underweight, the portfolio, when I'm transferring money into it, M1 Finance will automatically rebalance my portfolio without causing a taxable event. So what that means is I can go in here and I can manually rebalance the portfolio. So what that would do is it would sell my overweight holdings and buy into my underweight holdings and make everything equal based off of my target allocation. I don't do that because I don't want to have to pay taxes, at least not at this time. And so what I'm doing is I'm focusing on just dollar cost averaging into the portfolio, and M1 Finance does the rest. But there's another way to look at the historical performance in M1 Finance. So if you go under the research tab, you go under My Pies, you can find your portfolio and you can see the historical performance. So this chart or this page right here is just looking at the capital appreciation. This is not looking at the total return. It's not including the reinvestment of dividends. And so this percentage right here, this is not looking at the total return. If it was, it would be much higher given the higher starting yield of this portfolio. So in my portfolio, I have a handful of different slices. I have different companies in this portfolio. All of them are a little bit different, but as a total, they're averaging just right around a 5% dividend yield, and there's 12 holdings. And so the use case here is I would love to understand, when looking at the total return, how does this portfolio compare to maybe the S&P 500, or how does it compare to a real estate ETF? So does it make sense to invest into, 12 individual, holdings, or would it make more sense to just buy one ETF, either the S&P 500 or a REIT ETF? And that's exactly what we're going to take a look at in this video. So in order to do that, we're going to use Portfolio Visualizer. I've used this tool in the past on the channel. I will leave a link in the description below if you want to play around with this as well. It's not an affiliate link. It's just a link to this website right here so that you can do it. You can follow along in the video if you would like, or you can check it out whenever you want. So what I'm looking at here is I'm comparing three portfolios. So what you're seeing here over on the left, this is my real estate investment trust portfolio. I have Omega Healthcare, which makes up 15% of my portfolio, a massive amount. I love Omega Healthcare. It's under a lot of pressure right now because of the pandemic, but I believe, me personally, I still am a firm believer in Omega Healthcare. They did not increase their dividend here in 2021, so they are no longer on track to be a dividend aristocrat. However, I still believe in the long-term outlook of Omega Healthcare. There's probably going to be some short-term, headwinds, but I think over the long term, I think this is a great, great company. But obviously, that's just my opinion. All right, so the reason why I share that is I've shared Omega Healthcare in a few different videos. I personally am very bullish long-term on the company. The next one here is Good. Good makes up 15% of my portfolio. Realty Income at 12%. MPW at 12%, love MPW. VNQ, this is the Vanguard Real Estate REIT ETF at 11%. WP Carry at just under 11%. Stag just under 12%. And then we have Public Storage at 3%, Extra Space Storage at 3%, Prologis just over 2%, and then DLR at 2%, and then American Tower at 2%. So this is the portfolio weighting here. And what I want to compare is, how is my portfolio comparing to the S&P 500 in SPY? That's going to be portfolio 3. And portfolio 2 here is VNQ. So this is what I'm looking at. And what Portfolio Visualizer is doing is it's looking at the results of if I would have invested $10,000 back in January of 2012, up until today, I would have reinvested the dividends. What would have been the historical total return of each of these portfolios? Now, obviously, what you're watching here on your screen, this is my portfolio. You could do the exact same thing with any different use case. Let's say you want to compare this to maybe technology companies, growth stocks, value stocks, small caps, whatever it may be. If you're curious about, the historical performance of different asset classes or different portfolio mixes or only ETFs, whatever it may be, whatever floats your boat, you can do with this portfolio visualizer. So the one thing that you do want to note is if the investment has not been around for a long time, there's obviously no historical data or limited historical data. So for example, covered call ETFs do not work very well because they've only been around for a few years. So covered call ETFs or ETFs that have only been around, or SPACs, or companies that just went IPO, just be aware there has to be historical data to be able to backtest historical data, right? In the words of Dwight, don't be an idiot. So understand that don't just understand that that's going to be the case. So we're comparing my portfolio with these two other portfolios. So when looking at my portfolio, assuming we invested $10,000 back in January of 2012, my portfolio, the final balance would be $39,756. Once again, with the dividend reinvested. Portfolio 2, this is the Vanguard Real Estate ETF, would have a total portfolio balance of $27,075, so significantly less. And then the third portfolio, making up of the S&P 500 ETF, would have had $43,839. So in this scenario, portfolio 3, in terms of a total return, the S&P 500 would have been the best investment. Now, that's when looking at the total returns. So in order to get that 43,000, or to get cash flow or income from that portfolio, you would have to, in some cases, sell off some of your shares in order to get the same cash flow that I would be getting from the dividend income from my portfolio. So very, very important. So let's say I invested from 2012, I now have $39,000 versus the S&P 500. My portfolio is pumping out much more income, though it has a similar balance. So does that make sense, right? My portfolio, much larger dividend yield, pumping out much more in dividend income. I can generate the same amount of income / return with the S&P 500, but I would be required to sell my shares. So very, very important. So the next thing that I want to look at is the CAGR. This is the compounding annual growth rate of the total return. My portfolio would be just at around a 15% compounded annual return, whereas VNQ is just 10.5%, and then the S&P 500 at 16%. So this is really, really interesting. What really catches my eye is my portfolio, despite having Omega Healthcare and Good and Realty Income as the highest holdings, this portfolio is still standing with the best of them. It's still very, very similar. It's seeing similar returns as the S&P 500. These are some rock star REITs that are just massively pushing out, cash flow, and it's just incredible. So if you were to look at, these companies on a Google or a Yahoo chart and just see the capital appreciation, it looks pretty lousy. But if you incorporate if you look at it from a total return from the dividend reinvested, this portfolio is kicking butt. Like, it's doing really, really well. Now let's look at this from a different view in terms of looking at it, in a chart from year over year. So portfolio 1, that's my portfolio. That's the blue one. The red one, number 2, is VNQ. And then portfolio 3, the orange one, that is the S&P 500. And the thing that I want to highlight here is what you'll notice is you'll see right now, yes, okay, the S&P 500 is beating my portfolio. But what was it looking like right before the pandemic? Before the pandemic, my portfolio was actually beating the S&P 500. And so it's really, really cool to see. I don't know what that's going to look like going forward, but it was really cool to see actually, before the pandemic, my portfolio was beating the S&P 500. And if you look at the annual returns, so the blue one being my portfolio, red VNQ, and orange the S&P 500, some years that kind of stand out to me. The 1 year where my portfolio performed the worst was in 2015, and where my portfolio has performed the best has been in 2012 and in 2018. And we know in 2018, what was the big issue in 2018? It was the Fed raising interest rates. The Fed are raising interest rates. What did the Fed just say that they're going to do next year? They're going to raise interest rates. So my portfolio, I don't have a crystal ball, but I'm feeling really, really good with this portfolio going into next year, where we know that interest rates are likely going to go up. But, I just want to put that disclaimer, no one knows. So time will tell, but I'm feeling pretty good about it. And then lastly, when we look at the annualized returns, my portfolio year to date is up just about 20%, actually underperforming the other two. When looking at it year over year, my portfolio is up just under 25%. Over 3 years, up 13%. Over 5 years, up 14%. And then since 2012, my portfolio has had an annualized rate of return of just under 15%. That's incredible. You look at portfolio 3, it's up 16% annualized. So this portfolio, when you look at this, when you look at these like WB Carey, Stag, Public Storage, MPW, like this is not Microsoft. This is not Amazon. This is not Nvidia. This is not Tesla. These are great. These are really, for the most part, established REITs with massive dividend yields. And really, like, it's just a whole different ball game when comparing this portfolio to, the growth stocks that we see in the S&P 500. But when you compare the results, they're so comparable, and it makes me feel like, hey, I'm on the right track here. So this is really, really cool. And if you do end up using this website, something that's kind of cool, everybody is a little bit different in terms of how they like to view things. You can actually download this as a PDF. And when you pull up the PDF version, it will look like this. And you can scroll down, you can see the assumptions here, $10,000 from the start date. This start date will depend on the assets in the portfolio that you're viewing. It's rebalancing annually. And yes, the dividends are reinvested. So this is actually an important thing here, that it's rebalanced annually. So I personally am not rebalancing my portfolio, but however, I am using M1 Finance, which is essentially rebalancing it for me anyways. So if you use a platform like Fidelity or a different brokerage, you would then need to rebalance annually to see the exact same numbers. But with M1 Finance, it does it for you, which is pretty dang cool. And then if you scroll down, you can see, the portfolio itself. That's my portfolio, the real estate, yada, yada. And then you can see here the actual metrics. You can see, what your in balance would be. You can see what it would have been adjusted for inflation. You can see the annualized CAGR adjusted for inflation. And you can see the best year, the worst year. And then you can see the performance. It's just a different view. And, it's just depends on your personal preference. But the thing that I think is so cool is really comparing the annualized returns to maybe different portfolios, maybe the S&P 500 or something else. And then here you can see, okay, are you getting the total return that you should be given your time horizon? Maybe if you're in your 20s or if you're in your 60s, you really looking at, the investments and the risk tolerance that you may have depending on your specific time horizon. Thank you so much for watching, everybody. I thought this was really cool to see how my portfolio was comparing to the real estate REIT ETF from Vanguard and the S&P 500. If you're going to invest into something other than the S&P 500, I think it's important to have that as a benchmark and understand how your portfolio is performing when looking at the total return. I hope everybody has a wonderful holiday. I hope that you get to enjoy time with your family. Thank you so much for watching. I hope that you learned something new, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.